Everybody's been freaking out about the Iran war and what it's going to do to the stock market, and I get it. Anytime there's a major geopolitical event, especially something involving the Middle East and oil, the first reaction is fear. People start saying that the market's going to crash, oil is going to explode, volatility is going to spike, and everybody starts speculating. But when we actually look at the numbers, the story is a little different. The Iran war started on February 28, 2026, so the last market close before that was February 27. At that time, the S&P 500 was sitting at around 6,878. Fast forward to June 9th, and the S&P 500 closed at 7,386. So even with all the headlines, all the fear, and all the back and forth, the S&P 500 is actually up about 507 points, which is roughly 7.38% since before the war started. Now, that doesn't mean the market didn't have volatility. It absolutely did. We saw the fear come in. We saw oil spike, and WTI oil went from about 66.96 to around 95.96, which is a huge move of about 43%. But what's interesting is the VIX, which is basically the market's fear gauge. That was around 19.86 before the war, and it's currently at 19.87. So it's basically flat. And that's the point I want people to understand. Headlines create emotion, but the market reacts to more than just headlines. It's looking at earnings, interest rates, inflation, the Fed, oil prices, investor sentiment, and whether the actual damage is enough to change the bigger picture. So far, the market has had plenty of reasons to be nervous, but it's still higher than where it was before the war started. That doesn't mean ignore the risk, but it does mean don't let fear-based headlines make your investing decisions for you.